By the way, I was educated at Santa Clara University in the London School of Economics. I came out in retirement and estate tax planning. I worked for American Express, declined the World Trade Center position, so got intervention there for one reason or another, so I ended up in San Francisco. So I understand your business very well. I don't know your business now. I have not been practicing estate tax person for quite some time. I've been a real estate and a hospitality entrepreneur. My whole goal here is to make sure that if you have a client and they have a business, that they get out of that business at the optimum value. What I call a strategic partner is if you gather that data for your clients, I'll review it and show up and we'll talk about it. We'll just talk about where they want to go. Here's your business, here's where you want to go. I may give a quick call to a couple people and see if I can get a good idea of what might be a solution. No charge, no cost, but I can't have hundreds of strategic partners across the country. So we're trying to focus on the ones that are long-term planners, the ones that are not just money managers, the ones that beyond the business, what happens? Are there charitable foundations involved? I have my own Giving Legacy plan where I believe that someone's life really actually starts when they sell their business. Now they get to work. There's a great quote by Winston Churchill. He said, you make a living by what you earn, and you make a life by what you give. And I just can't see $30 million being stripped out of a business owner when that could go to an incredible benefit of where that family would want that money to go. That just makes no sense to me, because an investment banker says, hey, I only went fishing in these ponds and this is the highest number that I could get. So that's what we do. That's the focal point of where we're at. What's happening with your competitors? Are your competitors merging? Office Space, for instance. Office Depot and Office Max, they're rolling along, doing great. Fell asleep at the wheel. Staples just dominated the storefront. Just took them over, almost like a tidal wave. Online, Amazon.com just took over the online. So Office Depot and Office Max are sitting there at 3 and 4 going, oh, wait a minute, what just happened here? Well, we better merge. We're both spending too much money on fixed costs and administrative costs, so we better pool that together. And let's look at the redundancies and let's try and figure that out. I don't know if anyone has Office Depot as their client in this room, but who was 5th? Who was 6th? Who was 10th? When all of that happens, when all of those mergers are starting to happen, when things are changing, you better get ahead of it, because when it's time to sell your business, if you've been losing altitude and the rest of the industry has been merging, it's a very, very difficult conversation to have. When the investment bankers have already taken the business, they've already put it up for sale, the rumors have already started, everybody's already cashing out, and instead of the $180 million that you were expecting in your business, because that's what the valuation people said your business was worth at a 7.5 multiple, the investment bankers say, I can't get any buyers. I mean, there's some people that are coming in at 140 or 130, but for them to make the decision at that time, well, forget it. Just time out, let's turn it around. Let's put some things in place that can make us more attractive. That's a hard time to decide when the preoccupation of all of your people has been somewhere else. They're focusing on whether they're going to leave, whether their jobs are going to remain. So that's what we look at. We look at that whole marketplace. What is that lost equity and how do you measure that? And what changes can be made? So these are the stages of what we go through. We look at an initial evaluation. Where is this company currently right now? What is it facing? What states are they in? What's the cash situation? What's the line of credit situation? Where do they want to be? If they want to exit at any time in the next 5 years, you got to look at it now, because the industry could do this. Our goal is to maximize that optimum value. So maybe it's year 3. Great. Well, what changes do they need to make? We go to the source. We go to the industry. We go to the trends. So our investment banking partners start with us and the clients. The investment banking partners know the industry, and they say you need to diversify geographically. You need to work on your supply chain, and you probably need to get a transportation unit west to East Coast. That's what we then do. We then start on those processes, and then the investment bankers take a break, and we end up doing the work. So once we get the assessment done, then we go and we find the specialists in that industry. We are not going to presume that we're going to know everything about every industry, and I'll show you the industries in a moment. Then there's a second measuring. There's a pre-improvement phase. Before we start improving anything or going down that road, we have to go verify what we've put together. So it's again looking at the states, looking at the projections, looking at a 5-year projection with any cash changes, then the improvement phase, and then you can go into a transaction with the improved entity and have the investment bankers now do their job to get it where they need to go. The state of the company. If you can do your own state of the company analysis, we do state of the company analysis, but I would definitely urge you to address these items, and especially that one. That is a specialized SWOT analysis. What are the strengths and the opportunities for your client's business from the acquirer's standpoint? From those that are going to be acquiring the business or merging, what do they think are important? What do they think are the key items that are going to get that business where it needs to be? Even if it's 5 or 6 years down the line, keeping up the annual meetings that you have with your clients, how's that going? And if they have management consultants that are specialized in that industry, that's your subject matter expert. What are they seeing? What are the trends that are happening? But the management consultants are primarily fee-based. So that's not their job. You have to force them to do it. You have to ask them the question. Sometimes issues happen. Business owners die, major crisis happens. Since we're always looking at it from the acquirer's standpoint, we will jump in a crisis, we will stabilize things. We have an entire placement system where we'll drop those executives in where they need to be dropped. There are plenty of executives that are not employed right now that are semi-retired or consultants, but they're very knowledgeable of what needs to happen and don't want a long-term engagement. So, what are the industries we're looking at? These are the industries. And we'll be happy to provide all this data for you later if you want, but we found that these industries are the ones that have the biggest pliability, the biggest stretch. There's either a consolidation that's happening, there's either a trend that's moving in a certain direction, and these industries are going to be moving a lot quicker in the next 5 years. So we have specialists in each of these industries. Investment banking specialists, management consultants, we do human resources, we do organizational development. KPMG did a study that came up with the top 6 keys. What is it going to take to get a perfect merger done? And they have 3 soft keys and 3 hard keys. The number 1 soft key, executive leadership. Who's running that show? Who has control over all of the people? Number 2, the culture. And it didn't say, see if there's a cultural issue. It said, resolve the cultural issues, especially when you have 2 companies that are coming together. So these industries we're very focused on. We have data that comes in often. Here's an example in a hospitality company. Offer came in, that was 100%. We put some internal company sales programs together, some distributor and channel partner loyalty programs, customer rewards programs, increased the ending value, the sale value of 34% just from those top line EBITDA numbers. So you automatically just gain another 15% of value because you had the time. The investment bankers aren't in any hurry because they get paid a lot of money to make sure that they maximize that value. The client will always walk out with more money than when they showed up, because we take a percentage of everything above the strike price of where that business is. We get 0 if we don't improve the value. So we actually choose the client because we can't miss the mark. But when we're choosing the client, we have all of this data doesn't mean that just because we don't take a deal that it's a bad deal. It might be because it's too well run of a company. There's not much room. So we will focus it straight to the investment bankers that should get the highest value right then and there. And that's only if the client wants to sell. If the client doesn't want to sell, we're off. We don't really talk to them at all. So 161% of the original offer in 14 months. The current value of the business to the optimum value. Not what it could, the most it could sell for today, but what's the optimum value of what we should get it to? What does it deserve to be at? So 0 all the way to 100%. It's already at its peak right now. It can't get any higher. We're not going to start working with a business till it gets to about 45%. Because we can, for the most part, do some good work to get that value up. We're going to stop working on it when it hits about 83%. We give it a score. So 6 and above is really all we're going to work with. But at about 83%, there's a 15% buffer. The business owner thinks that their business is worth 15% more than it actually is. So at 83% of its optimum value, they're at 98. They're not gonna want to do this. So this is our sweet spot right here, about 65%, because we can make changes. We can take the 150. In fact, this is a great example. We can take a $151 million business, and at the end of the day, sell it for $215. And they make an extra $50 million after everybody in the equation already got their pay upon the transaction. And if we have to bring in people that do the work right there in the business, that's just a standard, hey, we have to come in and make some changes. That's about 75% of what they would normally pay if they're going to go call a consultant to come in. And then we take care of the balance. So, because we're not taking a percentage of the company, we're not taking a percentage of the increased profits, we ask them to fund about 75% of whatever changes, which income tax strategies, they're usually, if you can dump it into a charitable trust early on and take advantage of the 30% AGI, you can usually help them with some of those costs.